Hello, my name is Kojiro. Welcome to my channel, Good Vibration. If you have not subscribed yet to this channel, well, subscribe for future videos about the law of vibration, trading, and the financial markets. Okay, today I'm not going to talk about the law of vibration. I am mainly going to talk about a review price action technique called the two-leg pullback. This two-leg pullback is a very powerful technique, very popular technique, traded by many traders that I have seen also in other channels in YouTube. It's very popular and it's based in price action. So this is what I'm going to review today. So what is the two-leg pullback? Well, mainly the two-leg pullback is a technique based in a movement. Here we can see it here, in an impulse, a correction, and then a second impulse. Because this lies in the concept that the markets like to move in pairs. So this is like the basic structure. It's always present in the markets, in the financial markets, and it works in futures, commodities, Forex, and also stocks. Everything moves in pairs, and it looks like a ray or a lightning to the uptrend when it's in the uptrend, or the same thing to the in a downtrend. So it's basically composed of one impulse, correction, or another impulse. The same thing if it's going downtrend, one impulse, one correction, and one impulse. So basically what we're gonna look for, what this technique or this method is based, is we can see it here clearly. We have an impulse and we have a correction here, but we are going to look mainly for a correction that has this structure of a two-leg pullback. One leg or one impulse down, a correction, and an impulse down if it's in an uptrend. So we're going to look for this structure, for this price action to develop in the markets, whatever is it that people trade. So after we have this here, this correction here, we're going to look to enter at this point here. This is our entry point. We're going to look here to enter the trade here. Of course, we're going to look for based on the price action methodology, a bullish bar, nice, very bullish bar here that might show us strength to the upside, so that we can take this trade to the upside. And well, many traders trade this, what they call the naked price action, where, well, they don't use no indicators or other sorts of thing or other stuff. It's only the bars, the candlesticks, and well, maybe not even volume. They don't even use volume. I have seen that they don't even use volume. They only base their trading on the candlesticks. So, well, that's true price action. Well, I don't trade it that way because I like to look for other stuff to confirm the trade, to have a higher probability of winning the trade. So I actually look for the confluence of other stuff that might tell me that this here, it's a good entry point and a good trade and it's a high probability trade, you know. So that's how I do it. I don't actually trade it, you know, only the price action. And the last thing I check is the bars that show me, you know, a lot of strength to the upside. That's the last thing I check, but I also check other stuff. You know, for instance, volume or RSI, or maybe a killer channel, or even Bollinger Bands or Fibonacci retracements that tell me that this is a good place to enter. And if I don't have that, I will usually not take the trade, because I try to only take high probability trades. And it's the same thing in a downtrend. We look for an impulse down, an initial impulse, then we look for a two-leg pullback, which is a retracement here, and we're going to look at this point to entry. This is our entry point. Of course, we're going to look for, I'm going to look for the confluence of, you know, other stuff to confirm the trade. And the last thing I check again is a bearish bar in this case, that will actually tell me that this is a good chance of having a winning trade. So I will enter here in a short position to the downside. And this is basically the structure we're going to look for. And I've seen and I've known traders that only specialize trading only this structure or price action method, and they are very profitable doing this. So I actually don't trade this technique every day, but it's nice to have it in the trading toolbox. So I actually trade it from time to time when I actually see it very clearly in the markets. And if I see it clearly, and I do all my checklist as I do it, and if it's a good trade, I will usually take it, because it's a very powerful method or technique to trade. Usually, well, nothing's 100% in trading, but it's a good chance that it will go, it will be a winning trade. Okay, so there are two basic scenarios that I trade with this technique. One of them it's a trend channel, in this case to the upside. So this is an example to the uptrend trending channel. So the first thing we have to do is to check that the we already have a price action here, you know, a price movement. And the first thing we have to check is that the channel is actually, you know, reliable. We have to validate the channel. We have to see if this is a consolidated channel, that it's, you know, it's already telling us that it's a reliable uptrend, and we can trust the resistance and support lines of the channel. The first thing we have to do is to draw properly the channel, the trend channel, and the next thing we have to do is to check if it's a consolidated channel. So one way of the way I do it is to see if it actually touches at least 3 points here in the channel. We have one here, 2, 3 points here, and we have another one in the upside, at least 2 or 3, 1, 2, and 3. So after checking this, we can see it is a consolidated channel. It's already validated, so we can trust it's reliable to think that this is an uptrend. we can confirm this is an uptrend. So after we have this, I usually check for this. You can see this here, this structure here, which is the two-leg pullback. We have an uptrend in a consolidated channel, validated channel. We have an impulse here, and we have a two-leg pullback, a correction, one leg correction, second leg, and we're going to look to enter this trade here. Our entry point is to enter here after it's it bounces from this support level here. And that's the way I trade this. And usually this is going to be my entry point here. I'm going to ride the trade up to until it touches the other side here of the channel. Usually, sometimes I only take a scalp here, a few ticks, because I trade futures. Other people might like to let it ride. Well, that depends on the taste, the trading style of each one. But this is how I do it. I usually use this only for let's say it's scalping. I use this only for scalping a few ticks when I see it. So it's very powerful if you use correctly in the trend channel. But this is one scenario I use it. It's very reliable. Of course, it's not 100%. Once I get used to it, and I can see it clearly. That's why I can see it clearly here, and I maybe you can see it clearly here, of course. But sometimes in the charts, candlestick charts, trading charts, we cannot see it very clearly. It's sometimes confusing. So this is the basic structure I look for when I'm going to trade this method on technique, the two-leg pullback. And I'm going to take this trade to the uptrend here with the trend. Some other people, and I do not recommend this, but some other traders I've seen they take the two-leg pullback even in an uptrend. For instance, here they have a impulse to the upside. They have a correction here, which is a two-leg pullback. Then they have this second impulse, and this will constitute as a two-leg move. And the idea behind this technique is that markets like to move in pairs, and in impulse in pairs, one correction and two. So they will enter counter trend here, for instance, in a short position to the downside. And I usually do not recommend this, and I don't take this type of trades because it requires a lot of experience. It's not easy because, well, we are against the trend. So my recommendation is to take this trade with the trend. If it's an uptrend, and to enter with the trend in a long position, in this case here to the upside. But I'm mentioning this because some traders actually trade here to the upside, and they will also enter counter trend here to the downside. So, well, that depends on the risk tolerance and a trading style of every trader. And just mentioning the possibilities of this method and technique. So why does this happen? These two-leg moves. Well, experienced traders or new traders actually fall in this trap very easily. And I remember I did fall for this trap when I was starting, in trading, because it doesn't matter if we see here the most beautiful price action bar, bullish bar, telling us that this is going to go up. It usually gets taken out with the next impulse. Well, it is actually like a trap here because people fall for this, especially new traders. So when we know this, and I learned this technique, I usually wait for the second impulse to form here, and the more experienced traders will enter at this point here. They will wait for the second impulse down, and you know, new traders or that enter in a hurry to the upside, they will get taken out because usually their stop loss are here at this point here. They're taken out, and the more experienced traders will enter to the upside here at this point here. So, well, yes, it's always better to enter the second impulse when it is completed the two-leg pullback. This is something that works. If you check you know, charts, a lot of them, you can see that it's always moving usually in two-leg pullbacks, in two legs. An impulse, two impulse, one impulse, correction, and another impulse. And this technique using the trend channel, it will work the same to the downside. Just as I don't have it here, but it is the same thing, vice versa to the downside, and it will work the same. Okay, so this is the first scenario that we use in the trend channel, and the second scenario I use this is using support, important support on resistance levels, or you know, moving average, or whatever well, you are using, because I don't like to, you know, I like to show the concept of this. I don't like to tell people, you know, you have to use the 20 moving average, the EMA, 20 period EMA, or the 50 or the 89. Well, that depends very much. The idea here is to use this technique with the moving average that you feel comfortable using, that you have been using a lot of times, that you know they work, that you can see them and you've been using them a lot of time. And well, the support and resistance levels where they are obvious to use. So I will actually this is the other scenario I use this technique. So let me explain here how I do it. Imagine we have an impulse to the upside here, then we have a correction here, and this is a two-leg pullback here, as you can see. And this is what we're going to look for. It looks very clear here because we don't have all the candles and all the movement and all the chaos when we're trading real time in a chart. But the idea behind this is that, well, it is not easy at the beginning, because you have to train the eye, to look for this the structure or pattern, and to train and to learn the candlesticks when we can use them according to the price action methodology. Once we have that, then it's easier, but it's not, you know, sometimes I also don't see them very easily, but they are usually there. So it takes a lot of practice. So my recommendation is that, well, if you're gonna trade this technique, you have to train a lot and practice a lot in demo, and then again you could trade this before trading this with real money in a real account. Okay, so how I do it: we have one impulse here, we have a correction, which is a two-leg pullback. We can see it clearly here. So I'm looking to enter at this point here, if it's an uptrend here, because this is it could be a important support level there, or a important moving average that you use. So imagine this is the 200 period moving average here, and it gets just to this point there, and then it forms a nice bullish bar, telling us that this is going to go to the upside according to the price action methodology. So this is our entry point here, and we would like to catch the second impulse up. This is how I take this kind of trades. So this is my second scenario, using support, important support or resistance levels, or important moving average. It could be the 20 EMA, it could be the 20 is the simple moving average. Well, I don't like to enter to say, you know, you have to use this one exactly. You can use whatever you're using. Just I'm showing here the concept of how to use it. This is how I use it. I don't trade this every day, but this is a very nice technique to learn and to have in mind. You know, in the trading toolbox to trade. If it presents, well, then you can take the trade. So here we can enter here to the upside to get the impulse, and to the downside will be the same thing. We have one impulse here, then we have a two-leg pullback to one important support, or in this case will be our resistance level, or important moving average that you're using there. Could be this important moving average or resistance level. So here we have this will be our entry point once we check for the confluence of other stuff or indicators that tell us that this is a good place to enter. And the last thing I usually check, it's the that has a bearish bar, in this case, very bearish bar that's telling me that I can take the trade with confidence, and it's a high probability trade to the downside. And then it goes down. So mainly this is the structure I'm looking for when I'm going to trade these techniques. And the other way I can trade this, I usually look for, not as often as this are the corrections. This is also valid when trading, and it's when it completes two legs to the upside. But this is more tricky, and it requires more experience, because sometimes you know, it could go up again according to the Elliott waves, you know, because they actually move the first impulse, corrections, second impulse, there's another correction. Sometimes it does three impulse to the upside, and then it will fall. So this requires a lot more experience, but you can trade it also. I mean you can check sometimes and it will work, but this requires more training and more experience. And if it completes two legs in this way, we can enter at this point. So we want to look for the confluence of other stuff, other indicators, as I use it, because some price action, pure price action traders, they will only use the candlesticks and nothing more. Anything more, they will only use the candlesticks. So I use indicators because I like to reconfirm my trades, and I found out that using indicators to confirm the trade improves the probability of winning the trade, because trading naked price action only using the candlesticks, well, it requires a lot of experience. and it takes a lot of years to understand it, you know, or to fully grasp the concepts of price action in that way. So I usually complement the price action with other stuff. So if I have that here, I will enter this here within a short position, the downside, and it also works to enter here for the long position here. So we have an impulse here, a correction, and then we have another second leg to the downside. And if it stops here with a nice bullish bar and the confluence of other indicators, you know, other stuff that tells me that I can take this trade, I will take this trade to the upside. In a long position here, looking for a nice and powerful bullish bar that shows me strength. So this is basically the second scenario. So the first scenario is the channel, trend channel, and the second scenario is using support, important support and resistance levels, or moving average. So let me show you. So let's have a quick review here of what are the types of bars according to the price action methodology that I will use to take the trade. So let's imagine, for instance, that we're at this point here. We have already followed this, an impulse, and we have a two-leg pullback to this point. Oh, sorry, here. We have a two-leg pullback to this point. And we have a nice support level and also a I don't know, important moving average here, the 200 period moving average at this point. Let's imagine we're here at this point. So what we're going to look for is, we'll see something like this. Let's imagine we have a important support level there. At this point, we're here, right at this point. I'm gonna show the bars there. So the first thing I look for is something like this. I am gonna look for this is a pin bar or a hammer that shows me a lot of strength, bullish strength, green. That so we have it comes here with a red candlestick, you know, at this point, and it tests the support level and maybe goes through, but it comes up, and it forms this powerful bullish bar that closes in the upper third. You know, it has to close in the upper third of the bar, and it has to close 100%. It has to close above the support level if we're going to take this in a long position to the upside. So after having this, usually goes this way. So where do I I'm going to place my stop loss here. This has to be that way, 1, 2, or 3 ticks below this point here. This will be our signal bar that's signaling the entry that we can enter the trade, and this is the last thing I check before I enter this type of trades using this technique. But the stop loss has to go 1, 2, or max 3 ticks or pips if you trade Forex, or cents if you trade stocks, below this bar here. And the entry point should be, and how I use it, and how it is actually usually used in this technique, is to use a stop market or stop limit order 1 tick above this bar here, usually here. So when the price action comes here and takes this to the upside, it will take the order, execute the order, and we're in. This is how I use it. And well, I usually prefer to use the stop limit orders and not the stop market, because sometimes due to slippage, well, I might actually get filled a few ticks here in the up. So I like to get filled here, so I usually use the stop limit orders. But well, that depends on the trading style. Some people like to use this with the stop market order here, 1 tick above. Well, you can use that also. I use this with a stop limit order, and the other way we can enter this trade using this technique is sometimes I use normal limit orders to enter this trade. I wait sometimes to the price action to come inside the bar, this signal bar here. I place a limit order here, and it will execute my order and then go up to the upside. And well, it has, you know, its advantage, but also there are some few things against this, because well, you might not get filled using the limit order. The good thing about using the limit order, the normal limit order, is that you reduce your risk, and the risk is the distance between the entry point and the stop loss. The stop loss is here, and we can reduce the risk, because if we enter with a stop market or stop limit order here, we can reduce the risk a little bit to here. But sometimes the problem with this is that it won't get filled. We won't get filled if we use limit orders, because for instance, when there's a lot of momentum and a lot of force to the upside, it will, you know, this second bar here will start going up immediately to the upside, but we don't have chance here to enter the trade if we have a limit order down here at this point. So well, sometimes it's better to use a stop market or stop limit order 1 tick above the signal bar, that is this one here. But if we have the chance, if I get the chance to, and I see the price comes back inside again, I will take the trade here, because this is a good well, it reduces the risk. And well, this is how I take. And so this is the first thing I'm going to look for, pin bars or hammers, or in the case of to the downside or downtrend, it will be the same thing but in the opposite. So it will be an inverted hammer which closes red, and if it's to the downside, it has to close below the resistance level in that case, and to the upside it has to close above the support level, because if it closes here, well, this is not a good signal, because maybe it will bounce here and continue up. It will bounce here at this and continue going down like this. So we want to make sure it's going to go up, so we have to check, and I always check the bar, my signal bar closes above the support level. If it's going to we're going to take the trade to the upside, and usually it will go this way, immediately there, or it will come inside and then start going up. And the trade, you can trail, some people, you know, only trade a few ticks when trading this technique. Other people let it run a little bit more. Some people traded a few points. But that really, I will not get into a discussion about that, because it really depends on the trading style. I just like to show the concept, and each trader might, if they like, they can they can check for themselves and see what it works better for them. So they can scalp a little few ticks, they can let it run. Well, that depends very much on each trader's psychological and emotional makeup and risk aversion and the trading style. So I will not discuss, but the possibilities are infinite using this technique. Okay, the next thing I will look for is imagine we're here again at this point here, and we have this impulse down there to an important support level. We have this candlestick there at this point, red, like this. So this is the other scenario I'm going to look for at the bar level. Check if it's a good trade. So I will look for, first of all, pin bars or hammers, and I will also look for engulfing bars. If I get an engulfing bar here like this is a pretty good indication that this trade is going with a lot of force, bullish force to the upside. An engulfing bar that engulfs this bar. So it works the same. The stop loss definitely has to go 1, 2, or 3 ticks below this, which will be my signal bar in this case. In this example here, the stop loss should go 1, 2, or 3 ticks below this signal bar here. And the entry point should be 1 tick above this bar, with a stop market or stop limit order here, 1 tick above this bar. So I'm gonna wait something like this to look for something like this. So my orders is gonna get filled, and I'm gonna go to the upside there. And the other way we can enter this engulfing bar is using plus normal limit order. And again, we can wait for the next bar to enter into the signal bar zone here and use a normal limit order. And this is good because we can lower risk again here. Our entry point, the risk is the distance between the entry point and the stop loss. And well, that sometimes won't happen because there's a lot of force, so you will just do something like this and start going up. So those are the two ways I use this. Okay, and the last example I'm going to show how I take these trades. I personally take these trades is using something like this. Oh, the engulfing bar has to close above. It has to be an engulfing bar as I take these trades. As how I do it, has to close above the support level. Okay, and the last one will be what I call it a double bottom at the bar level. Here we have a double bottom here, you can see here, double bottom there, the stop loss here, 1 2 3 ticks below. This will be my single bar here. The stop market order here, 1 tick above this this bar here, using a stop market or stop limit order to enter the trade. And well, again, we can use normal limit order if sometimes we get the chance. We can use a normal limit order there and wait to the price action to enter the signal bar here. And this is another opportunity we can have to lower risk. Many times it doesn't happen, it just takes off right away. We don't have the chance to, and the time, because this happens very fast. We don't have time sometimes. And this works in any time frame and in any financial instrument, futures or Forex or stocks, whatever people trade, everything that's tradable, because these patterns usually form in the markets, financial markets. And I use it usually for scalping and for short moves, short high probability trades. I take this and we'll go for a few points. And well, it's how I do it. Other traders might use it, they can let it roll and use a trailing stop to secure the trade. But well, that depends on your trading method. Okay, so this is basically the two ways I use it, using trend channels or important support or resistance levels or moving averages. So let's take a look at some examples. Okay, here we are. So let me show you a few examples of this technique, the two-leg pullback technique with real candlesticks here. We are in the micro S&P 500 futures, and I'm using tick bars, but you can use as well 3 minutes, 5 minutes, or well 15 minutes, whatever time frame you use to trade. You can also use tick charts or volume charts. Well, that depends on the trading style. So first thing we have to do is find a channel. I have draw properly trend channel. In this case will be a downtrend here, and we have to check that this is a consolidated and validated channel. And we can see here it touches at least 3 times, 1 2 3 here. It goes out a little bit, but it's valid. And here in the downside it's 1 2 3 times. Also here it comes a little bit out, but it's actually validated. We have a downtrend channel here at this point. And we can see here that we have a two-leg pullback. We have a down impulse here, a two-leg pullback here in magenta or fuchsia, and right here. Let me take these lines out of here a little bit to show it easier, because when we are trading this in real time, in real charts, candlestick charts, sometimes it's not so easy to spot. So that's why we have to train the eye to see, so we can spot easily these two-leg pullbacks. But here we can see that it applies here the two-leg move. We have this impulse down here to the support level of the channel, this point here, and we have a first leg here, then a second correction here, and a second impulse to the upside, and this breaks a little bit the resistance of the trend channel here. But it closes below. So at this point here, if I was at this point here in real time, I would check the confluence of a lot of stuff here. If you notice here, I'm using a Kellner channel here and a couple of moving average here. I have a white moving average here. This blue line is also a moving average here. The green one is also a moving average, and this yellow, it's also a moving average, 200 period moving average. And I have a volume here, and I also have a RSI here. And sometimes I use this setup like this to trade this technique. I do not trade this every day, but when I see these kinds of trades very clearly, a confluence of a lot of indicators or moving average or something that's telling me that I can take the trade, I will usually take the trade. So here we can see it's clearly a two-leg move to the upside. We are in a downtrend. So if I will enter this this trade, the stop loss should go one tick above. The last thing I check, it's the price action here. So I check here that this is consolidated channel. We have this bar here, that's the bar that's signaling me the strength to the downside after the two-leg move to the upside. It closes below the resistance level of the trend channel. And I have another indications here, for instance, a rejection of the moving average. Price action actually rejects the moving average. If you see here, there's a blue moving average here, and rejects this resistance level of the trend channel. And then there's a rejection of this green here moving average. And there's also a rejection of this white moving average. So it actually rejects all the moving average at this point here, and it forms a very nice bearish bar, inverted hammer or inverted pin bar. It closes almost in the lower third of this candlestick here, of this bar. So yes, it's a go. I would take the trade. The last thing I check is the price action of the bar. So this is a pretty bullish, a pretty bearish bar here. So the stop loss has to go right above here, 1, 2, or 3 ticks above this bar, which is my signal bar. And the entry order should come around here, below 1 tick below this signal bar, using a stop market or a stop limit order here at this point. And well, off it goes, because it actually, the next bar here, this green bar, it actually executes the order here, kind of try to retest again, but we are never in trouble at this point because again it shows a lot of rejection and it doesn't quite get up to the point we have our stop loss here, if you can see here clearly at this point, and then off it goes to the downside. This is usually a long move to the downside when you have one leg here, two leg pullback to the upside, and then the other long impulse down here. All this, and this will have been a nice trade. It's how many points? 53.50 to 35, almost 20 points. Yes, short of 20 points. Oh, it would have been a nice trade if you're in the mini S&P. The same thing will have been a nice, very nice trade here. And the other way we could have entered this trade here is if in this case we could have used a normal limit order here, because we had a retest to try to retest this level here. So actually the price action comes inside the signal bar here. So we would have gotten filled there, and well, would have been nice also because the risk will have been reduced a lot here, and off it goes again. So this is the two ways I use to enter this type of trades, and this will have been a very nice trade, almost 20 points, shy of 20 points will have been a nice, very nice trade. And as I said before, you can go for a couple of ticks, you can go to scalp a trade, just a scalp, a little scalp there, a few points, or you could trail the stop. For instance, as the trade advances in your favor, you can trail your stop and keep on trailing your stop there until it takes you out of the trade. So this is a very nice technique. Okay, I have here another example here that I marked here. Well, you can see that it's not as easy as it was, when I was explaining with the line charts, because using the candlesticks sometimes it gets confusing. That's why it's better to train the eye and practice a lot to see these types of how the price action actually unfolds, to spot effectively this type of trades, this type of method and trading technique. So here we have another one, two-leg pullback, two-leg move here, and this is not actually the trend channel type, but the other type, because here we have the Kellner channel, which I usually use. It could be used also Bollinger Bands. Well, that depends on the trading style, on the type of indicators you use. And in this case, it will have also been a nice trade, because well, actually we have a first impulse here, we have a correction, and then there's a second leg to the upside here, but within this leg here we have a two-leg move. So we have a two-leg move within another two-leg move, the completion of two-leg moves. So it will have been a very nice trade also. Let me show you here. I'm going to remove these lines so we can see clearly here. So once it completes here, because this is one impulse here, correction, the second move here, second leg to the upside, it hits here the Kellner channel, and then this bar will be our entry bar or signal bar here, which is telling us that we have a nice chance to the downside. So actually, well, if you use the Kellner channel or the Bollinger Bands, if you notice here, every time it hits and closes outside or touches, there's a rejection. And when this happens, the price action, the price will try to go to the other side, as it did here at this point, or if you can see here, here it comes here and there's a rejection because price action, once it hits this level, I will try to go to the other side, to go inside the Kellner channel and to the other side. That's how it moves. Of course, using only the Kellner channel and the Bollinger Bands is not guaranteed it will happen, but using his confirmation also works. This will have worked also if we had here a resistance level. Well, we actually have here our important resistance level that comes from here. You can see this point there. So we have a resistance level there. We have the Kellner channel. So that's the kind of confidence of confirmation that I'm looking for. Not only the structure, which is very powerful in itself, but I like to check with other stuff. So here we have the two-leg move, the Kellner channel, and this resistance level here. Then we have a very nice looking bar using the price action methodology of the power to the downside here. A lot of strength, bearish bar, this red bar here. And this is the last thing I check, the bar, the strength in the bar. That's what will give me the go or not go into the trade. Analyzing all the context of the trade in itself. So at this point, I will have placed my stop loss here. At this point here, 1, 2, or 3 ticks above this bar, which is my signal bar that's telling me, okay, you can enter this trade. This was a nice inverted hammer there, closing in the lower third of this bar here, and it will have been a nice opportunity there. And again, the entry point should be 1 tick below, always below this bar, which is my signal bar here. So using a stop market or a stop limit order here, and when it executes the order here, we can see a nice move to the downside here. For how many points? Let me check here. If we enter one, there will be 50 to 50, 33, almost 20 points again. So 20 points in the mini S&P or micro S&P, it will be a very, very nice trade. So this is actually how I trade this. I have to check again. I don't use only how many traders only check the price action there, but I check other stuff like the resistance, support levels, moving average, or Kellner channels, volume, or RSI, all this stuff together in context as confirmation to take the trade, and this improves greatly the chances of winning the trade, the probability of winning the trade. So that's the way how I do it when I trade this type of technique. You can see here, and well, the other way you can enter this trade is you can use a limit order here. In this case, well, maybe yes, it came back a little bit. The next bar, this one here, it went inside again, and when we get this chance here, this type of entry, well, we reduce our risk, because the risk is the distance between our entry point and our stop loss. So we greatly reduce risk, and well, that's pretty nice when we can do it, when we have the chance to do that. In this case, we have the chance there, and inside, and off it goes. This price action went to the downside there. And actually, here we have another one here. Let me show you. Now that we're here at this point, I didn't mark it here because at the beginning I wanted to show the trend channel, but this is a two-leg pullback actually to a not to the channel. Well, let me delete this channel for a moment there. But to a the other end, the other way that you can take these trades are if you have it hits and it shows rejection from a important support or resistance levels. In this case, there's a moving average here. And sometimes, you know, the challenge with this type of trades is to learn to spot them effectively. You can see here's a two-leg move. We have a down impulse, a two-leg move to a let me move on these lines again here. Two-leg move here, goes up, comes down, and goes up again. You have to check the ticks or the pips, or if you're trading Forex, or cents, because each tick counts when you're counting this type of legs. You see, in this case, it goes up, comes down, goes. It has to be very clear with the eye, then goes up again. So there's a two-leg move there clearly. And if you can see, there's rejection again here from a in this case the blue moving average here, this bar here, then we have this white moving average here. So it rejects actually two moving average, closes below, as you can see here, this red signal bar here closes below, and this bar here, which is our signal bar, it's a very nice bearish bar that closed really, you know, very bearish, closed in its lower third. And if I would have taken this trade, the stop loss has to go here, one tick, two or three ticks above this bar, which is my signal bar, the bar that's telling me to, you know, it's safe to take the trade. And again here, the entry point will be a stop market here, or stop limit order here, one tick below this bar here. And we have to check that this bar closes below, as you can see here. Can you see it here at this point? Closes below the important, in this case will be this moving average, the white moving average closes below this point. We can see that one tick below there, and then it we're in the trade and kind of tries to retest this level here, but we see again clear rejection here, this next bar there, and off it goes. Well, actually it retests 3 times this blue moving average there, this point, and then off it goes. It will have been a nice trade also, because this will have been how many points? 57, 50 around here, 47, 10, almost 10 points. Yes, 10 points. And then the other way you could have entered or this trade, you could use a normal limit order here. Let's say one tick here, and well, we could have reduced the risk to this point using a limit order, normal limit order there, when you retest and it goes down again. Sometimes it doesn't happen. In all these examples, there was some kind of retest, so we could have entered the trade using normal limit orders, but usually there's a lot of days it doesn't actually happen. There's a lot of momentum to the downside and you don't see the retest, it actually goes down. So using limit orders, sometimes we will not get filled. Let me show you another example I have here. This is my last example I'm going to show you here. So we have here a clear impulse to the upside here, and we have a two-leg correction there. Again, two-leg correction. Market here in magenta or fuchsia here, we can spot it easily. At the beginning, it's not so easy to spot effectively. It's better to practice a lot the eye and in real time before trading this with real money in a real account. And here we have one leg down, correction, second leg down here to a moving average here, this point here, green moving average, and here we have the Kellner channel, also this red dotted line here. So we have two things, the confluence of two things here, plus in this case will be the let's say this bar here, my pin bar, which is a very bullish bar. It closed in its upper third, and if I will have taken this trade, I will have placed my stop loss here 1, 2, or 3 ticks below this bar, which is my entry bar, my signal bar, which is telling me I can take the trade. We can see clearly rejection of this moving average, green moving average here, and a lot of rejection from the Kellner channel. So this is nice setup. If I will have taken this trade, I will have seen it in real time when I'm in my trading session, and the entry should go 1 tick above this bar here, there, 1 tick above this bar, using a stop market or a stop limit order. I usually prefer to use the stop limit order because well, it's more exact. Because sometimes due to slippage, well, we might get filled a couple of ticks here in the upside. Well, so I prefer to use a stop limit order, but if you have to get filled, stop market order will do the trick. And then we can see this will have been actually a nice trade here to the upside. I will have gotten out here at some point here, but you see some people will let it let it run for a little more, so it goes up to this point here. But you have to have hold for a lot of swings, because it comes here, comes down here again, go up, comes down here again, go up. So I use this mainly for scalping, and I will have gotten out probably around here. A nice scalp here of how many points? 10. If I enter here, will be to 8 points. Nice scalp there. And well, that's how I trade. I hope you can easily see my examples here, how I trade this technique. I know there's a lot of traders that trade this technique in a different way. This is how I trade it. Well, okay, well, that's all, and I hope you like this video. If you did like this video, well, give me a like there, And well, don't forget to subscribe to my channel for future videos regarding and about the law of vibration, trading, and the financial markets.